Are you confused about investing? As an example, you hear terms like brokerage account, Roth IRA, ETFs, stocks, and it all just feels like a giant pile of financial jargon. Well, you're not alone. A lot of people want to start learning about investing, but no one explains how everything actually fits together and where to start. It's like being handed puzzle pieces without seeing a picture of the box. In this video, I'm going to simplify it all by breaking it down into what I call the layers of investing. Hi, my name is Vasily Zois, and I'm a fiduciary advisor with over a decade of experience helping people make educated decisions regarding their investments, taxes, insurance, and overall financial planning needs. As an advisor, I get a lot of similar questions, and I like to take a step back to the fundamentals. Instead of thinking of investing as all these different confusing pieces, think about it like a stack. 4 simple layers working together. Once you understand these layers, investing suddenly makes a lot more sense. The first layer, or where you typically begin when you want to start investing, is with a brokerage or custodian. These are third-party companies that hold your money and investments for you and facilitate your trades, where you buy and sell various investments. Think of it like a combination of a bank and a shopping platform for investments. Brokerages and custodians are where you go to actually open up the different types of investment accounts. Some common names include Vanguard, Fidelity, Charles Schwab, Altruist, Interactive Brokers, Pershing, or Robinhood. This is typically the very first step, or what I call the top layer when it comes to investing. You basically have to decide which platform or brokerage or custodian you want to use. They are all very similar, and you can typically trade most of the same investments at each one. What typically differs is the user interface or platform and fees. So picking one over another doesn't necessarily mean a better rate of return, better service, or better investment options. Typically, it's just personal preference. Our independent registered investment advisor firm uses a few different custodians, but we primarily use Altruist to open up all of our client accounts because we've noticed that their platform is light years ahead of some of the other firms that we've used in the past, which makes it easier for our clients to navigate and for us to do day-to-day tasks and be more efficient and productive for our clients. So once you find which brokerage or custodian you or your advisor is going to use, the second layer is the type of account you want to open. This is where you will hear terms like IRA, Roth IRA, custodian account, or individual brokerage account. You can typically open up as many accounts as you need, depending on what your specific needs and goals are. The platform that we use to open up our client accounts allows us to open up 35 different types of accounts, broken down into the following categories: high yield savings accounts, retirement accounts, non-retirement accounts, accounts for minors, and business accounts. Each type of account serves a different purpose. Some have special tax treatments and are meant for retirement, others are meant for minors or for businesses, and others are just normal accounts with no special tax treatments or limits. Contrary to what some people might think, that type of account doesn't necessarily dictate the rate of return you will receive, but instead, that is dependent on the investments that you hold within the account. That's what actually matters. This is what leads me into the next layer. So after you open up the account with a brokerage or custodian, you will fund the account with money, and either you or your advisor will be able to purchase different investments, which takes us to the final 2 layers. Layer number 3 consists of investment funds. For the vast majority of people, honestly, probably 90% of investors, layer 3 is as far as you need to go. Funds are where the magic happens for most people. So, what's a fund? A fund is simply a basket of many investments bundled together into one. Instead of buying one individual stock, you buy a slice of hundreds or thousands of stocks in a single purchase. Think instant diversification. There are 3 main types. The first type are index funds. An index fund tracks a market index, the most famous being the S&P 500, which is a collection of the 500 largest publicly traded companies in the United States. When you buy an S&P 500 index fund, you own a tiny piece of all 500 of those companies. The fund doesn't try to beat the market, it just mirrors it. And because there's no active management involved, the fees are typically extremely low. Decades of data show that most actively managed funds fail to outperform simple index funds over the long run. Index funds are the backbone of most smart long-term investment strategies. Now, the second type of fund are ETFs, or exchange-traded funds. ETFs are very similar to index funds with one structural difference. They trade on the stock exchange throughout the day, just like an individual stock. An index fund is typically priced once at the end of each trading day, whereas an ETF can be bought or sold at any time the market is open. For most long-term investors, this distinction doesn't matter much. Many ETFs track indexes, like the popular VOO from Vanguard, which tracks the S&P 500. So the term ETF and index fund often get used interchangeably, even though they're technically different things. Now, the third type of fund are mutual funds, which are pooled investment vehicles, just like an ETF, but it's only priced at the end of each trading day and is purchased directly from the fund company rather than on an exchange. Some mutual funds are passively active index funds. Others are actively managed, meaning a fund manager is making decisions about what to buy and sell, which typically results in higher fees. Now, those fees are called expense ratios, and they can eat into your return over time. A fund with a 1% expense ratio versus a fund with a 0.03 expense ratio might not sound like much, but over 30 years, the difference in your final balance can be enormous. The bottom line to remember about Layer 3 is, for most investors, a simple portfolio of low-cost index funds or ETFs spread across U.S. stocks, international stocks, and maybe some bonds, depending on your timeline, is generally all you need to start. Then there's Layer 4, which is where most people want to start and where most people probably shouldn't start. This is individual securities, individual stocks, individual bonds, REITs, options, and so on. When you buy an individual stock, you're buying ownership in a single company. If that company does well, great. If it struggles or fails, you feel the full impact. There's no diversification cushion. This is why individual stock picking is generally hard, not because it's complicated to buy a stock, but because consistently picking stocks that outperform the overall market is something that even professional fund managers with teams of analysts and decades of experience fail to do reliably and repeatedly. That said, there's nothing wrong with owning individual stocks as a portion of your portfolio if you enjoy it, you understand the company, and you're doing it with money that's above and beyond your core diversified foundation. A lot of investors keep, say, 90% of their portfolio in index funds and use 10% for individual stock picks. That's a pretty reasonable approach. Individual bonds work differently. You're lending money to a company or government, and they pay you interest over time. Bonds are generally more stable than stocks and play a role in balancing a portfolio, especially as you get closer to retirement. Most individual investors access bonds through bond funds rather than buying individual bonds directly, because buying individual bonds requires a lot of capital to do efficiently. The key message to remember on Layer 4 is that individual securities are a legitimate part of investing, but they belong on top of a solid foundation, not in place of one. So let's recap. Each layer serves a distinct purpose. Layer 1 is the brokerage or custodian that holds your money safely. Layer 2 is the account type which shapes your tax outcome. Layer 3 are the funds which give you diversified, low-cost exposure to the market. And Layer 4 consists of individual securities that let you go deeper if you so choose. That's the 4 layers of investing. It's not glamorous, it's not a hot stock tip, but understanding this framework will generally serve you better over a lifetime of investing than an individual trade ever could. Hopefully this video helps you understand more about investing and some of the terminology involved. If you enjoyed this video, subscribe to the channel to learn more investing, planning, tax, and insurance insights. If you have any questions or are interested in investing, there's a link in the description of this video where you can schedule a time to talk with me directly for a free, no obligation meeting. Thanks for watching.